Morning, everybody. Welcome to this morning session where we are going to have a look at bank reconciliations. So this will be lecture 3. Lecture 1 was the introduction to accounting. The second one was general ledgers. And today we are going to look at bank reconciliations. So I'm going to get straight into it by starting to share the PowerPoint. So the first question is, what is the purpose? What is the bank reconciliation actually? So the purpose of the bank reconciliation is to prove that our bank statement balance agrees to our accounting records. So in our general ledger lecture, we captured all of a whole number of transactions in the trust and the business bank. But as we are human, there's always the risk that there's a transaction that we capture at either the incorrect value or that we capture it, we miss a transaction or we possibly duplicate a transaction. So what we are going to do is, as soon as we've finished our accounting for the month, then we pull our bank statement and we get a balance off our bank statement. And then we compare whether that balance agrees to our accounting records. If it agrees, then we know we've captured all transactions at the correct value. We haven't skipped any transactions and we haven't duplicated any transactions. So bank reconciliation is also a fairly old concept, but it's still something that we do today. A few years ago, we didn't have internet banking. So in today's terms, we will mostly, when we do our accounting, go on the bank, download our latest bank statement and do our accounting from there. So our chances of having reconciling items is not that good anymore. So what happened a few years ago before internet banking is you will have a whole number of supporting documents in your office. This will be things like client receipts. So every time a client comes to your office and they pay either in cash or they do an EFT or they give you a check, you would have issued them a receipt. And then all of these receipts will be captured on my business cash book or trust cash book on the debit side, because that will increase my cash book balance. And the same with proof of payment. And then I will write out checks. Sometimes, well, we don't really use the checks that much anymore, but back in the day, we would do most of our payments by check. So the general rule with the check is the moment that you write out and sign the check, we have to capture that check in our accounting records. The reason for that being is our accounting records must always be the correct reflection of what has happened. Now, the moment we write out a check, we must accept that that money is basically gone out of our account, because your client can at any stage go and deposit that. What actually happened, as a practical example, at one of our clients is it's a larger firm, and for instance, the owner of the business wrote a check to the client. They still had a balance left on trust, and the client kept that check and didn't bank it. 2 months later, the accountant worked through the accounting records and realized that there's still a balance on that client's account because they didn't account for the check on the day that they wrote it out. They said that's fine, they'll account for it the moment it gets banked and they'll pick it up from the bank statement. So it still reflected a balance on the client's trust account, and the accountant then paid them out via EFT. And some weeks later, the client then went to the bank and deposited the check. And suddenly you're in a position where you have a trust shortfall because you've now paid the client twice. So the rule with checks are that we account for them in our accounting records the moment we write them out, sign them, and give them to the client. Okay, so what we then do is we have this list of, well, we have all our supporting documents and we do our accounting, or we compile our accounting records to the best of our knowledge with these documents that we have. Then sometime after month end, we'll now receive our bank statement. And then once we've received our bank statement, we can now go and tick off all the transactions. So you'll literally sit with your bank statement. If there's money that came in, you'll tick it off on your accounting records and you'll tick it off on the bank. If there's money that you paid out, you'll tick it off on your accounting records and you'll tick it off on the bank. And then at a certain point that will either agree, and if all the transactions are ticked off, then it means that your cash book and your bank statement have the same balance. And then later in the lecture, we'll have a look at reasons why there would be differences. So basically, a bank reconciliation is a single document that we draft at the end of the month. So it's basically it's not like a ledger that has a running balance from day one and you just add to it. It's a new document. It's a document that we compile snapshot at month end to say, this is my bank balance per my cash book, this is my bank balance per my statement, and if there's a difference between those two, these are the reasons why they differ. Okay, so let's look at why would bank statements and cash book not agree. So the first one is a check banked, not yet cleared on the bank statement. So as I just said, the moment we write out a check to a client, we account for that in our accounting record. So we load that check as a transaction on the credit side of my bank or of my cash book because it decreases my cash book balance. Now, in my accounting records, I've showed that my bank balance is already less or it has already decreased by that amount of the check. But now, if my client has not yet banked that transaction or banked that check, it would not yet reflect on my bank statement. So if I wrote the check on, say, the 20th of the month and we get to month end, my cash book balance will show minus 100 Rand, but my bank balance will only reflect a zero balance. So what I do, I normally teach it to you guys and say, look at each transaction as if it's the only transaction in the world. So let's say we have no other transactions and I give my client a check for 100 Rand. That will, in my cash book, decrease it by 100 Rand. But if he hasn't banked it yet, in other words, there's no other transactions, my bank balance will be zero because they don't yet know about the check. This might seem a bit confusing at this time, but I'm going to keep using this example throughout, and as we do the teaching example, and then hopefully it will become a bit more clear. The second reason is receipts issued to client, not yet banked. So let's say a client walks into my office and he gives me 100 Rand note to settle his account on the last day of the financial year. On that day, I decide I'll only go and bank it next week, but I have to issue the client with a receipt that he has paid the money. So the moment I issue him with a receipt, I have to go and load a transaction in my cash book on the debit side to show that the cash book has now increased. But if I haven't banked it yet, and that's the only transaction in the world, my bank statement will still have a zero balance. So there's a valid reason why my cash book balance and my bank statement would differ. Now, in these two examples that we looked at now, where we have a check that was banked or not yet banked, and a receipt that we issued and not yet banked, those two items will be reconciling items, and we will add them to our bank reconciliation. So in effect, what my bank reconciliation is my bank reconciliation will tell me in future what will still happen on my bank. So the check will reflect on my bank recon because it shows that in future my client will go and bank that check. The receipt will also reflect on my bank recon because it says that in future I will go to the bank and deposit 100 Rand. Now let's look at accounting errors. So another possible reason why my bank statement and my cash book will not agree is because I made an error. So we've got accounting errors and bank errors. So accounting errors are errors that are made on my side. bank errors are errors that the bank make. So you'll remember earlier I said that our accounting records must always be a true reflection of what is or what has happened. So if I now go and let's say I wrote out a check to client to the value of 100 Rand, but I accidentally captured it as 200 Rand through a finger error. Are my accounting records correct? Because did we really pay out 200 Rand to the client? And the answer is no. So because my accounting records must always be correct, I must now go and reverse the incorrect transaction and repeat the correct transaction. So accounting error will not reflect on my bank recon. I will have to go to my actual cash book and fix that error there to make sure that my cash book records are correct. The other reason why it does not appear on the bank reconciliation, it is not a transaction that will correct itself in future. It's not something, it's not telling me what has to happen in future. It's something that has to be fixed now. And then the last reason why we can have a reconciling item is because of a bank error. Example of that will be something like I deposit 100 Rand in my business account, but the bank accidentally credits it, so they put it against my trust account. Now the question is where or whose accounting records are correct, assuming I posted it correctly on my side. My records are correct, so I'm not now going to reverse my business receipt and recapture it as a trust receipt. I will leave that transaction as a reconciling item on my bank reconciliation, because the bank reconciliation tells us what will happen in future, and in future the bank will have to correct that error. So those are the 4 types of transactions that we can have. So a check that hasn't yet been banked is a reconciling item. A receipt that hasn't been banked yet is also a reconciling item. Accounting errors we have to fix in our cash book, and bank errors will be reconciling items as well. So let's look at some general rules when it gets to bank reconciliations. So the first rule is our ledger must always be a true reflection of the transaction. So that means for any transaction that the question gives you, we must ask, is our records correct? If a transaction did happen, have we accounted for it, and have we accounted for it at the correct value? If we've made an error, we have to fix it on our side. If someone else made an error, we can put it on the bank reconciliation because that person will have to fix it in future, but we don't know when that's going to happen. The next note says, or point number 2, is if the transaction will still appear on bank statement, we enter it on our bank reconciliation. So that will be the check and the receipt. It's a transaction that is a true and legitimate transaction. It's captured at the correct value. It just hasn't reflected on our bank statement yet. If the transaction, that's number 3, if the transaction will not go through the bank in future, reverse in cash book. Now, an example of that will be a stale check. So let's say we issue a check to our client and they don't bank it in the first month. So we show it on our bank reconciliation because it can still happen in future. Month 2, month 3, month 4, month 5, month 6. We keep it in our bank recon because it is still likely that the client will deposit it in future. But after the 6th month, that check has now become stale. The moment the check goes stale, we know that it can never be banked in future. So although we've accounted for the check, now the moment we know that it will never go through in future, we have to reverse that check in our cash book. Then point number 4, if our accounting records are incorrect, reverse and repeat the correct transaction. Why? Because as we learned in point number 1, our accounting records always have to be a true reflection of the transaction. And then point number 5, if the bank made an error, you fix that error on the bank recon, and that will then tell us that the bank will in future have to fix that error. So now we're going to start with this little 100 Rand method of mine to try and understand how these bank recons work. So your cash book is a key account that we did last week. A bank recon will start with your cash book balance. So we'll always carry our cash book balance as the closing balance from our cash book on the left. And then we have our statement balance. And now if my cash book balance and my statement balance differs, then I'll have to either add or subtract something in the middle to get that to recon. So let's look at this transaction and work through it. So our question is, will the transaction go through the bank in future? So we've issued check 1 to client. So because it's a check payment to client, we will account for that on the credit side of our cash book because my cash book balance will decrease. Now, assuming this is the only transaction in the world, will my cash book have a closing debit or credit balance? And the answer is it's a credit balance. In other words, this cash book is in an overdraft. So the moment it's in an overdraft, you will carry a negative balance into my bank recon as the opening balance. Now let's first skip the middle line there. Our cash book balance is negative 100 because we issued a check to client. If that client hasn't banked it as at the date of my bank recon, and this is the only transaction in the world, what will my statement balance be? If I go and I look on my actual statement, the balance will be 0 because nothing's happened. There's a check that's been issued, but the guy hasn't banked it yet. So my statement balance will be 0. Now we can say we know our cash book is at minus 100. We know we have to get to 0. So our first rule is we have to add outstanding checks because minus 100 plus 100 equals 0. So the first rule is we add outstanding checks. Now just be very careful. Just make 100% sure about this. These rules that I give are applicable if we start our bank recon with our cash book and we end with our statement balance. If you were to switch this around and start with a statement balance and end with a cash book balance, then all of your pluses and minuses will be switched around. But for purposes of my lecture and for our training example, we're going to have start with our cash book balance, then have our reconciling items, and end with our statement balance. So that's the first one. We've got an outstanding check. It's a current check. So for the time being, we can assume it will still pass through in future. So we account for that in our cash book. We carry our cash book balance over into the bank recon. Our statement balance is 0. So then we know we have to add our outstanding check to get this equation to work out. Now let's use the same example. We've got an outstanding check, but now in the period that we are doing the accounting for, this check has now become stale. So the moment we issue the check, we would write it on the credit side of our cash book because my cash book will decrease. Now, for the first 6 months, that transaction will be reflected as on the previous slide. But now after 6 months, we know that check cannot be banked anymore. So we can't enter it on our bank reconciliation because it will never happen in future. So the moment we know it will never happen in future, we have to reverse that check, to reverse the effect of that check, because now we can assume we haven't yet paid out that client. So because it's a minus on the credit side, to cancel that out, you write a plus on the debit side. And that will then be our reversal of the check. On my statement, if this is the only transaction in the world, I wrote a check, I gave it to someone, they never banked it, I will have 0 transactions on my bank statement. And then accordingly, my cash book balance will be 0, my bank statement balance will be 0, and I reconcile. So I won't have any reconciling items. You can actually delete that line out of there. Now let's move to the next one. The next one is an outstanding deposit. So this is the example where the client walks into our office and he gives us a 100 Rand note. Now, as we know, the moment clients give you cash, you have to go and deposit that at the bank within 2 business banking days. So let's assume this is on the last day of the month. The client walks into my office, he gives me a 100 Rand note, and in exchange for that, I give him a receipt. Now, the moment you print a receipt off your accounting system, the accounting system will enter that as a positive amount in your cash book on the debit side, because your cash book increases on the debit side. Now, as at month end, I've not yet deposited that amount at the bank. So what will my bank statement balance be if this is the only transaction in the world? My bank statement balance will be 0. So now, how do we reconcile that? I have one transaction in my cash book on the debit side of 100 Rand. That means my closing balance on my cash book will be 100 Rand on the debit side. I will carry that over into my bank reconciliation as a positive 100 Rand. Now, I know the answer to this is 0. I need to get to a statement balance of 0. And therefore, I have to decrease my cash book balance. So I have to enter a negative amount on my bank recon to get us from positive 100 down to 0. So our second rule is we less outstanding deposits. So it's add outstanding checks and deduct outstanding deposits. So if we look at our transaction, or at our questions, question 1, will the transaction go through bank in future? At this point, there's no reason to believe that it won't, and therefore we enter it on our bank reconciliation. Question 2 says, what if it will not go clear in future? Okay, there's a bit of a grammar error there, but basically what happens the moment we know that this 100 Rand will never be banked in future? Then, same as the stale check, we have to enter a transaction on the credit side to reverse it. Okay, so the first rule is add outstanding checks. Second rule is decrease with outstanding deposits. Now let's look at an accounting error. So we look at the same, we assume it's the same scenario as on the previous slide. I've got a client that walks into my office and he gives me a 100 Rand note. But I then accidentally capture that as a 1,000 Rand deposit. Now, in this example, okay, we'll get to the bank statement now. I capture that as a 1,000 Rand deposit. Now, sometimes later, I pick up that I have made this error. Now, if I have made the error and showed it as a 1,000 Rand deposit, are my accounting records a true reflection of what has happened? And the answer is no, because the client did not pay 1,000 Rand. So because it's my error, I need to correct that error. So you will correct that by reversing and entering a transaction of minus 1,000 Rand on the credit side of your cash book. But now the client did give me 100 Rand. So I've entered 1,000 and I've debited with 1,000 and I've credited with 1,000. So now there's no transaction. So I still need to account for the actual transaction. And that's why we then have a second entry on the debit side, which is our correct deposit number 2 to the value of 100 Rand. Now, let's assume the funds have been banked. So there's no reconciling item here. What will my statement balance be? My statement balance will be 100 Rand if it's the only transaction in the world. So let's see whether we reconcile. I've got a debit of 1,000, a credit of 1,000. So those two cancel out. And then I've got a debit of 100 Rand in my cash book. So that means my cash book will close off with a positive balance of 100 Rand, which I will then carry into my cash book, and my cash book and my bank statement balance are the same. So therefore we have no reconciling items in this scenario. So rule 1 was add outstanding checks. Rule 2 is decrease outstanding deposits. And rule 3 is when we've made the error on our accounting records, we have to fix our accounting records. We don't enter it on the bank recon because it's not a fix that will happen through someone else at a later stage. We have to fix our record so that it is a true reflection. Now, let's look at a bank error. So our example says a business deposit was accidentally banked in trust. So it means there was funds that should have been paid into my business account, but the bank made the error and accidentally put that money in my trust. So now you'll see now I've split on my cash book between trust cash book and business cash book. So we are now looking at the trust cash book. Will I have any entry on my trust cash book? And the answer is no, because this is a business deposit. So I want my cash book to be a true reflection of what the transaction should be. So in my trust cash book, I will not have any entries. If I have no entries, my balance that I carry over onto my bank reconciliation will be 0. And what will my bank statement balance be if this is the only transaction in the world? I have one amount that was paid into my trust account. So if I pull out my actual trust bank statement, that will have a balance of 100 Rand. Yes, it's an erroneous balance, but it is there. So how do we get from 0 to 100? We have to plus in this case. But it's not always a rule like a check and a deposit to say it's always a plus. It's going to depend on what the nature of the error is that the bank made. So it's definitely not always a plus. It could be a plus or a minus. So you'll have to apply this little 100 Rand method of ours to determine whether it's a plus or a minus. So when you do the assignment and you are unsure on whether a transaction is a plus or a minus, just draft these little recons that I did now, and then you'll easily be able to see whether it's a plus or a minus. So if you're a bit panicked at this stage, I want to put your heart at rest or at ease and say that if I recall correctly, the actual bank reconciliation in the assignment, I think only amounts to about 5 points. The bulk of the bank reconciliation question is actually just cash book transactions that you have to go and enter, normal transactions. So if it's receipts, you enter them on the debit side. If it's payments, you enter them on the credit side. Then there's 3 reconciling items on the assignment. So that is a bit tricky to go and figure out. But if you can't get that figured out, that's only 3 points in the entire assignment. The rest of them are all ledger accounts, which we did last week. But in any case, let's keep our heads together and our hopes up that we will understand bank reconciliations. The moment we get to the teaching example, I'm sure it will become a little more clear. So this is now in practice our accounting process. So what we do is when we start our accounting records for this month, we have to firstly bring our closing balance down from last month's cash book. Because whatever, just think about it logically, whatever you had in your bank account at the end of last month, you will have in the beginning in your bank account in the beginning of this month. So we start by bringing our closing balance down from last month. Then point number 2, we write up this month's cash book from supporting documents. So we take all of our receipts that we issued to clients and we write them on the debit side of our cash book. And all of our checks that we issued and our EFT payments that we made, we write on the credit side of our cash book. Then sometime after month end or at month end, we at point number 3, you will receive your bank statement. So once you receive your bank statement, you will go and tick off all the transactions in your cash book against the bank statement. So you will literally print out your cash book and you will print out your bank statement. And then if you see it on the cash book, see it on the bank statement, tick it off. Now you'll sit with 2 scenarios after you've ticked off. There will be transactions in your cash book that is not ticked, and there will be transactions on your bank statement which is not ticked. So let's see what we do with them. Point number 4, we write unticked transactions on the bank statement into cash book. So what does that mean? Why would I have a transaction that's on my bank statement and it's unticked? That means there's a transaction on my bank that I didn't know about or that I missed. But because it's in my bank statement, it means it has actually happened. The true reflection is what happened on the bank statement. This is obviously for any transaction except for a bank error. So let's assume this is a legitimate transaction. We just missed it. So because we missed it, it will show on the bank statement, but not in our cash book. And therefore, we have to go and write it into our cash book. Then, point number 5, we will have unticked transactions on our cash book, and those we will have to write onto our bank reconciliation. So let's just think about that. So in my cash book, I've got transactions and it's not been ticked. So what does that mean? That means I haven't found that transaction on the bank recon. Now again, it can only be one of 2 cases. Either it means I made an error and then I have to correct my error, or if it's a legitimate transaction and it just hasn't yet gone through the bank, then I have to write that transaction into my bank reconciliation. And then point number 6, carry unticked transactions from previous month's bank recon into this month's bank recon. So let's just think about that for a moment. So I have to do a bank recon at the end of every month. So I have to also include last month's bank recon into this ticking off exercise, because it could be that there was a check on last month's bank recon and now I see it on my bank statement. So the moment I see a transaction on last month's bank recon and on this month's bank statement, I have to go and tick it off. But what happens in the case where you've had a check issued to client and it hasn't been banked at the end of last month? Now you check your bank statement for this month and it still hasn't been ticked, or it still hasn't gone through the bank. Then it means we need to carry that check forward onto this month's bank recon as well. So I'm not going to write it into my cash book again, because my cash book, that check is already accounted for in my cash book. If I write it into my cash book again, I'm going to duplicate it. So I'm simply going to look at last month's bank recon and all the transactions on that recon that hasn't yet passed through the bank statement or reflected on the bank statement, we carry over onto this month's bank recon, and it will stay on the bank recon until such a time it does pass through the bank. Right, so now let's do a little training exercise to hopefully get you guys to understand bank recons a little better. So what I've done here is I've drafted a supplementary cash book. A supplementary cash book and a normal cash book works exactly the same. So for purposes of you guys being able to see, I've just added a debit and a credit column, and I'll add all my descriptions on the left hand side here. But for purposes of your assignment, this cash book must look exactly the same as our cash books that we did while doing ledgers in the previous lecture. And then I've got a bank recon. So now you'll see on my bank recon, I will have start with my cash book balance brought forward. Now, where am I going to get that? As I type transactions in on this side here, you'll see I've set the auto formula here. So if I have a transaction of 100 Rand on the debit side, it means my balance that I carry forward in my cash book is 100 Rand, and there it reflects there. So these two amounts, that amount I will get from here, but I can only get that after I've accounted for my entire cash book over here. And then at the end, this point, I'm going to have my bank statement balance. So I'm going to have a cash book balance, a bank statement balance, and if those two aren't the same, I'm going to have some items in the middle to explain why that and that is not the same. So let's start and read through the example. It says, please prepare the trust cash book and bank recon for February 2020. So this cash book of mine is only with reference to trust. So now line number 1 says, our trust cash book balance as at the 31st of January. So what does that mean? That means at the end of last month, my trust cash book had a closing balance of 500 Rand. So I'm going to enter that into my cash book and say balance brought forward 500 Rand. Now these first two steps, steps 1 and 2, are exactly like this in the assignment. So if you on your bank recon or on your cash book, just go and write the opening balance there, and then the second line says your trust bank statement balance on 29 Feb 2020 is 340 Rand. So I know my answer here. I'm going to say bank statement is 340 Rand. The moment you enter that, that's already 2 marks. So you only have to figure out the 3 reconciling items to get full marks. And if you've got no idea how to do that, you only lose 3 marks. So let's just go here. So at this point, I still have a difference. And hopefully with a bit of luck at the end of this assignment, I will have been able to reconcile that difference. Why do I have a difference? Because my cash book balance has a balance of 500. My statement balance has a balance of 340. And there's legitimate reasons which we now have to explain to our readers as to why those two differ. So let's start on the first one. The following receipts were on the trust cash book, but not on the bank statement. So that means in my cash book, somewhere up there in the history, previous to this one here, prior to this one here, I've already accounted for these transactions. But now it's telling me that it's not on the bank statement. So it means these transactions that I've accounted for previously does not reflect on the bank statement. So now we need to decide what to do with this. Then I said, okay, so the first one. On the 6th of February, we receive a proof of payment from client to the value of 300 Rand. So that means somewhere in my history up there, I had a debit transaction of 300 Rand because the client, it's a receipt, so it would have increased my cash book balance. So somewhere in the history up there, I'd have a transaction for 300 Rand. Now ask yourself, if the client on the 6th of the month gave us an EFT proof of payment for 300 Rand, and by the last day of the month, that is still not reflecting on my bank statement, does that sound like a legitimate transaction? Does it take 3 weeks for an EFT transaction to clear? And the answer is no. At max, it takes about 2 days for an EFT transaction to clear. So we can, in this case, accept that those funds that we deposited there will never actually occur and come into my, or be receipted into my bank statement. So what do we know now? If we raise the receipt there, we now have to go and reverse that receipt because it will never happen. The receipt that we raised because we thought the money was going to come in because the guy sent us a proof of payment. But now we don't think it's going to happen anymore. Now, if something is not going to happen in future, do we enter it on our bank reconciliation? The answer is no. The bank recon is for transactions that will happen in future. So in this case, the following receipts were on the trust cash book, but not on the bank statement. So I have to go and reverse this. So we say reverse invalid receipt, and I'm going to enter that as a credit. So we are going to deduct. Okay, I see I've set the formula to deduct. So now my cash book balance that I carry forward is 200, but I still don't reconcile. I have a difference. So let's look at the next one. On the 25th of the month, a client came there and he gave me a check. And I banked that check, but it does not yet show on our bank statement. Now we've got to ask ourselves, is it reasonable for a check not to clear in 3 days? And the answer is yes, it's very reasonable for a check not to clear in 3 days. It takes between 10 and 14 days for a check to clear. So do we have any reason to believe, so in this case, the value is also 300. So the moment the client gave me the check, I gave him a receipt somewhere up there of 300 Rand. Is there now reason to believe that it won't go through the bank in future? And the answer is no, there's no reason to believe it won't go through the bank in future. We believe it will still clear. So therefore, we will add this in our bank recon, because it means that in future that transaction will reflect on my bank statement. So what was our rule when it got to deposits? We less outstanding deposit number 2. So I'm going to enter minus 300 Rand over there. So now that doesn't affect my cash book balance, and now it's telling me my bank statement balance according to the reconciling items that I have is less or negative 100 Rand, but I know my bank statement balance is a positive of 340. So my difference is still 0. And then on the last day of the month, client walks in there and he gives me cash of 100 Rand. So I decide I'm lazy. So what happens? The moment he gives me the cash, I have a transaction of 100 Rand somewhere there in my original cash book, and I decide I'm not yet going to bank it. But I will most probably go and bank that on the 1st or 2nd of March. So do we have to reverse this transaction on the credit side, or do we add it to our bank recon to say that we believe this transaction will still happen in future? And the answer is because we still have 2 days to go and bank the funds, we believe it will still happen in future. So that's the same as the first one. It's an outstanding deposit number 6. And we decrease, we have a negative transaction on our bank recon. But we still don't reconcile, so we've got to go on with the exercise. Okay, so let's go to number 4. The following checks were in the trust cash book, but not on the bank statement. So that means those transactions were already captured on my original cash book on the credit side. But I could not yet pick up that they reflect on my bank statement. So check number 1 is dated the 28th of the 5th, 2019. So can that check still go through? Can that client go and bank the check? And the answer is no. So the moment we know something will not happen in future, we can't go and add it to our bank recon. The bank recon tells us what will happen in future. So we have to go and reverse that transaction. So originally we captured it on the credit side as 200 Rand. So to reverse that, we have to enter a transaction on the debit side of 200 Rand. And our description will be check 1. Now let's look at check number 3. check number 3 is dated the 26th of February 2020, and the value of that check is 300 Rand. So how long will we have or how long will that check be valid? So that check will be valid, if we write it out on the 26th of Feb, it will be March, April, May, June, July, August. So that check will be valid until the 26th of August. So that means until the 26th of August, we can assume it will still happen in future, and therefore we add it to the bank recon. When we do our bank recon on the 31st of August 2020, and that check has still not passed through the bank statement, then we have to go and reverse that check. But for now, we believe this is just a true reconciling item. So we'll say add outstanding check number 3, and we plus outstanding checks according to the rules that we set up earlier. So do we balance sheet? We've got 300 Rand there. We know we have to get to 340, so we still don't reconcile. So we've got to go on with our exercise. Now let's start with this. Number 5. The bank incorrectly credited my trust bank with a business deposit of 400 Rand. Now this is the tricky one. This is now higher grade stuff. The bank incorrectly credited my trust bank. So it means the money was physically put into my trust bank, but it should have been a business deposit. So now let's ask ourselves, who made the error? Did we make the error or the bank? The question clearly says the bank incorrectly. So this means it's a bank error. So we know we're going to have a transaction there of 400 Rand, but do we plus or do we minus? Now the only way to figure out this will be to use my little 100 Rand template. So we can use 400 Rand, still that makes no difference. So assuming this is now my trust cash book, so let me put that in there, TCB. This is a business deposit. So should I go and write a transaction into my trust cash book? And the answer is no, because my cash book has to be a reflection of what truly happens. Now, truly, this is a business deposit, so it should have absolutely no effect on my trust cash book. So what's the balance on my trust cash book? If I say it's my debits minus my credits, my cash book balance is 0. That cash book balance gets carried over into my little bank recon. And now, what will my bank statement balance be? If I go and physically check my bank statement, there was a business deposit of 400, but the bank put it into my trust bank. So if I look at my trust bank statement, there will be a balance of 400 Rand in my bank account. Now, how do I get from 0 to 400? And the answer is you have to plus 400 Rand to get from 0 to 400. So to reconcile this item, I have to say add bank error. And the only way that I could determine that was through doing this little 100 Rand method. That cash book balance I can link on my trust cash book over there. Then let's have a look at number 6. A business check was banked but deducted from my trust bank in error. So what does that mean? Again, this is a bank error. So now we need to figure out, do we add this or do we subtract it? So we know it's a bank error. We know there's an amount of 250 there, but we have to figure out, is this a plus or a minus? So it was a business check and they took that money out of my trust bank. So let's assume that's the only transaction in the world. Do I have to go and write that business check into my cash book there? And the answer is no, definitely not, because that would mean my accounting records are incorrect. So in my trust cash book, I will have no transactions because it's a business check. But if I go to my bank statement If this is the only transaction in the world, what did the bank do? They took that money out of my trust. So if I had no monies in trust and they took 250, how much will my trust bank balance be? Minus 250 Rand. So to make this equation work, what do we have to fill in the block? That's the part that we're looking for. So if I have nothing and I need to get to minus 250, I subtract 250 Rand. So in this case, we have to have a second line there that says less bank error minus 250 Rand. Okay, are we closer yet? Nope, still got a difference of 110, so we need to go on with the exercise. Point number, that should actually be 7. So point number 7 says trust interest of 200 Rand was received and trust bank charges of 400 Rand paid. So that means I now learn of transactions that did reflect on my bank statement, but I haven't accounted for them in my cash book. So it means up here, where I previously accounted, or my cash book up here, I have not accounted for that. So now the question is, do I put that on my bank recon, or do I add those transactions to my cash book? So let's first see for the guys who's thinking bank recon, will that interest and bank charges still happen in future? The answer is no, it has already happened. It has already been received in my trust bank and taken off of my trust bank. So that means my cash book is not correct at this stage. It's not reflecting that interest and bank charges. So the interest portion will increase my cash book balance. So I'm going to put 200 Rand on the debit side. And then in the same line, I'm going to say bank charges. And I'm going to put 400 Rand on the credit side. Why? Because it's legitimate transactions. It's not something that will happen in future, so it can't go there. It has already happened. So my accounting records need to be updated for transactions that has happened, but I'm not yet accounted for them. Okay, and then we get to the last one. Check number 5. Payment. So this is a negative check, was captured. Okay, check number 5 payment of 120 Rand was captured as 210. So what does that mean? That means somewhere up here in my original cash book, I had an entry on the credit side to the value of 210. So now let's first ask ourselves, who made the error here? Did the bank make the error or did I make the error? And the answer is I made the error. So I can't go and enter those transactions on my bank recon because it's not something that will still happen in future. I need to correct my accounting records up here is not correct, and I need to now pass more entries to correct them. So the first one that we do is we say reverse incorrect. And if it was a credit up there, means to reverse it, I'm going to enter it on the debit side. But now I've not accounted for the transaction at all because now it's 210 on the credit and 210 on the debit. So we still need to account for the original check. So I'm going to account for check 5, and because it's a payment, it will decrease my cash book balance. So I'll have to enter that on the credit side at the value of 120 Rand. Now I've analyzed all of the transactions where I've made mistakes or missed transactions. I've entered them into my supplementary cash book. Where there's transactions that has already been entered into my cash book up there, but it just hasn't passed through the bank yet. Those ones we show on the bank recon because that will still happen in future. And where the bank made an error and they need to in future fix that error, we also show on the bank recon. And now with a bit of luck, my calculation there. If you see the calculation, it says take my cash book balance, add and deduct some transactions. My calculated bank statement balance is 340. My actual bank statement balance is 340. So it means I have managed to successfully reconcile my bank account. Okay, so this should hopefully give you guys some guidance in terms of real life where you will need to go and do this. So just as a point on this, what do you guys have to look out for on bank recons? And the answer is transactions that increase your cash book balance. Because if there's a shortfall in your trust, what the accountants will do to hide that is they will write a receipt into the cash book, so a transaction on the debit side, but that receipt never comes in. They only do that to balance it. So they don't have a choice but to actually add that as an outstanding deposit. Which one was that? That was that one there. They don't have a choice but to add it to your bank recon. So the moment you have transactions like these that appear on your bank recon for a number of months, that must be red flags for you guys. So then you know there's potential fraud on your accounts. So after you've listened to this lecture, go to your accountant and ask them, please print me my bank reconciliation and have a look what's on that bank reconciliation. Because we have internet banking, the only actual thing that should be on your bank recon is potentially 1 or 2 checks if your firm still works with checks, and also possibly a trust to business transfer at month end, because your accountant will only close off your accounts towards the end of the last month, or towards on the first day or 2 of the new month. So then when he closes off your accounting system, he'll reconcile your trust versus what you will reconcile your trust in taking what you took out of trust versus what your system said you could take out of trust. So if you could have taken more, then they show that at month end, and that transaction you then have to go and physically do an EFT for. But be aware of transactions, of bank reconciling transactions that stay on your bank recon for a last time. That's a significant risk in real life. Yeah, and then just lastly, so please remember in the assignment, go into your bank cash or your cash book balance, that's 1 mark. Into your bank statement balance in the start, that's another mark. So that's already 2 of the 5 marks. And then it's only these 3 that are the really difficult marks that you guys will going to have to look at. Okay, that then concludes my lecture on bank reconciliations. So I'm going to stop sharing the screen there, and I will then start loading the next recording, which will be financial statements and business and cash flow.